Good morning, everyone. We're going to change gears here a little bit. As Mike mentioned, really privileged to moderate this next panel to talk about legal and compliance landscape. It's really great to see a lot of old friends in the audience. I haven't been out in a while. But for those of you who don't know me, I'm Chris Lanza, and I'm the co-head of the ACA Foresight distribution business, and really joined that firm 16 years ago to lead our build and our business into the ETF business. I've seen a lot of people that in the audience that started with me as well, and I met all the panelists at that time, and really pleased to continue working with them and helping our clients, shared clients. It's been really a privilege for the last 16 years. And I expect many of you really know our panelists too, but they're very broad expertise in their practices, and certainly experts on registered investment companies, ETFs, and really our discussion topics today. To my left is Jeremy Sendowitz, who's a partner and shareholder at Vita Price. Allison Fumé, to his left at Deckert, who's a partner. Peter Shea, a partner at K&L, and Bib Strench, who's a partner at Thompson Hine. We've got a lot to talk about today. We're going to try to touch upon a number of things, as Mike mentioned, post 6C11 or the ETF Rule, December of 2019. We're going to try to talk about that for about 15 minutes, and I'll ask the panelists to just join in and have a discussion on that. Then we're going to try to touch upon the ETF share class, ESG, which has been mentioned. I think Mike also mentioned that. We're going to talk a little bit about the funds rule. We're going to try to touch upon single stock funds, and time permitting, we'll also get into the oversight rule of providers. So maybe, Peter, if you wouldn't mind providing just a brief overview of the ETF rule for those in the audience who maybe are not familiar or didn't wait for 10 years like all of us did. Start us off, and then hand it off maybe to Jeremy to talk about the post-adoption of the ETF rule.
Sure, thanks, Chris. I think on the prior panel there was some discussion of Rule 6C11. That's the ETF rule we're talking about. It kind of leveled the playing field in the industry. Before then, the Securities and Exchange Commission had to issue exemptive relief for exchange-traded funds, which are basically mutual funds that trade on the exchange, to exist. Because in 1940, under the Investment Company Act 1940, they hadn't contemplated ETF. So everyone had to get a bespoke exemptive order to issue their own ETFs. The ETF, some of those exemptive orders had much more lenient terms and conditions than others. So it was just, over time, things changed. So the ETF rule leveled the playing field. But not only that, but it just reduced barriers to entry. And the emphasis on the ETF rule is basically one definitional. It's basically if you create and redeem shares in large aggregations and you use an AP, authorized participant, AP, to do that, and you're listed on a stock exchange, you're basically an ETF. And the majority of the rules is merely like, what do you have to throw up on your website? So the rule itself is all about transparency into the functioning of the ETF, whether it's the portfolio, whether it's performance or whatnot, it's all up on the website. And so that's the major impetus behind the rule. There are benefits to the rule, and we'll get into this much more in depth. And for instance, the rule specifically permits to avoid using creation unit size aggregations of shares and avoid using APs when it's like a merger reorganization type transaction to form the ETF. So that's opened the door to mutual fund to ETF conversions, private fund to ETF conversions, and SMAs to ETF conversions. So you're seeing a lot of reduced costs because of this. And also you have to keep in mind that simultaneously when the ETF rule came out, the SEC also issued a generic exemptive relief under a host of Securities Exchange Act of 1934 provisions that would prevent brokers, among others, from dealing in the ETF shares while they're also creating and redeeming ETF shares. So that's among many other things in that rule. The best thing you can say about the ETF rules is it's basically put ETFs under the same regulatory roof that mutual funds exist under. Before the ETF rule, that was not the case. So it's made things a lot easier. It's reduced costs, it's reduced barriers to entry. All the stock exchanges now have adopted generic listing standards that if you're an all it says, all these listing standards, all they say is if you're an ETF and you're using Rule 6C11, you can list on the exchanges. It's that simple. So it's created a lot more opportunity and ease of coming to market. In the meantime, we're witnessing what the reaction is and how the industry is reacting and what investment managers are thinking about when they're doing it. Jeremy?
Sure. Thanks, Peter. So since the ETF rule was finalized, we've seen a real flowering in the ETF space, an awful lot of new entrants. And in addition, and some of that is because of now that they no longer have to get their own exemptive relief, as Peter described. That's one set cost and obstacle of timing that no longer applies. So in that respect, that removed a barrier to entry. I think there are three other developments that have happened concurrently or with the ETF rule that have also played a really big role. One of them is something that Michael and the panel and the last panel discussed at some length, which was the growth of what are often called white label platforms. And while they go by different names and there are some different subtleties in the services they provide, generally speaking, these are platforms that provide much of the infrastructure for a new ETF to be launched. These platforms are incredibly attractive to newer, smaller managers that are that maybe have a couple of really good investment ideas and would like to put them into an ETF wrapper, but don't necessarily have the bandwidth to build the type of internal infrastructure you need to really manage an ETF complex. Anytime you anytime you launch a fund under the Investment Company Act, including an ETF, you have to have a lot of internal compliance and other infrastructure to make it work. And the type of efficiencies you can get in one of these platforms is incredibly attractive for a lot of managers. The second thing is also something that was discussed in the last panel briefly, the SEC's approval of semi-transparent ETFs. What that had the effect of doing was drawing a few major asset management players off the sidelines and into the ETF markets. And even though a lot of those managers, either previously or after they launched their semi-transparent ETFs, have branched out to varying levels of magnitude into transparent ETFs, still the opportunity to try out the semi-transparent vehicle was really attractive to a lot of managers and had the effect of inducing some big players to really take the plunge into the ETF industry. So in that respect, even though semi-transparent ETFs, in part because they've been limited, as mentioned in the last panel, to U.S. equities, there are only a set number of those products that have launched and have only garnered a few billion in assets. I think the impact that semi-transparent has had on the ETF industry goes way numbers of actual products that are out there under that banner.
Yeah, there's also, there's obviously, as time goes by, more data is coming on non-transparent active ETFs, and we're seeing the spreads of the current products are as narrow or narrower than like comparable index-based products. So there's a good deal of industry acceptance of these things.
Yeah, no, absolutely. I think the proof of concept from the first generation of products has worked relatively well. So over the next however many years, one of the potential new frontiers for the industry is going to be whether the SEC can be convinced to allow the semi-transparent model to be extended to fixed income and to non-U.S. Investments. The last item is something that was discussed in the last panel. We're going to discuss it some more length here as well, which is the flowering of mutual funds to ETF conversions, as well as SMAs and private funds. Just the it took a few years for the first conversions to occur, but once the proof of concept was established, we have seen a steady increase in the number of conversions, and we have seen a number of variations on it. It's not just mutual funds. We have seen the inclusion of SMAs. We've seen private, at least one or two private funds that have converted to ETFs. For most of these conversions, try to avoid getting a shareholder vote if at all possible. But we have seen a couple of conversions that have obtained shareholder votes, and they've worked. We've seen conversions of multiple mutual funds into an ETF, and we have seen a couple of major managers really use the conversion mechanism at scale to really get into the business in a big way. So I think that, while it's not, while I think some of the predictions that basically that every mutual fund is going to convert to an ETF is way overstated, still, I think most people in the industry expect a secular increase in this trend.
Yeah, we have seen, 22 companies, 42 funds, and more than $55 billion in assets thus far on that.
Right. And I mean, Dimensional literally went from 0 to, what are they now, 40 billion? Or so through conversions.
That's right.
That's a
44,
that's a pretty good demonstration of the capacity.
And none of this conversion activity existed before the ETF rule for the mutual fund to ETF conversions. It's just the SEC wouldn't give relief, but they contemplated for the rule, so here we are.
I do think it's important to hear what Jeremy said about not every mutual fund is maybe a good candidate for an ETF conversion. There's a number of things you really want to focus on with respect to the underlying shareholder base, what Jenica said in the last panel with respect to what's your distribution plan following. Mm-hmm. Obviously, it's a great avenue, as Michael noted, for a track record to move over, but ultimately, what are you going to do differently in the ETF? So I think a lot of firms are really thinking about what candidates are good for conversion, what candidates are good for let's start our own ETF, and a lot of other considerations. So those of you that think that ETFs are going to fully take over mutual funds, I don't know that we're going to see that anytime soon.
And one thing I would add too, it's not necessarily the fund complex making that decision. It's some of their customers. So the tax benefits, they're coming to and putting pressure on the fund complex and saying, why don't you convert mutual funds to ETFs? We're agnostic, and we want the benefits of this great product.
Great.
Yeah, there have been some lessons learned through the processes we've been through, at least. I'm sure Jeremy, Allison, and you, Bib, had similar experiences. The SEC has been forcing people going through conversion mutual funds to do the consolidation of share classes and terminating the 12B1 plans at the earliest possible moment. And that has some repercussions for the mutual fund managers having to carry maybe the tail liabilities of the 12B1 plans to make those payments out, because it takes about 30 days to terminate a 12B1 plan. And so what we're seeing is the SEC wants these plans terminated as soon as the board makes a decision to convert, and not do it at the conversion. So there's some nuances to all this stuff, but it can be overcome. The biggest issue has always been, what do you do with direct shareholders who don't have brokerage accounts? And how do you handle that? There's a lot, the industry's adapting to that. There are ways to deal with it. Likewise, what do you do about fractional shares? ETFs cannot issue fractional shares. So you see ways that have been designed to do that. Obviously, stock splits help, things like that, and also rationalizing share valuations to make sure that you have an accessible price when the ETF conversion occurs.
Right. And we've seen that the SEC is focused on these items. Recently, they mentioned in their exam priorities for the coming year that they're going to be looking at mutual fund to ETF conversions as one of their priorities. So in that respect, an industry development has arrived when the SEC puts it on their priority list for inspections.
So great discussion. Really nice to have 6C11 behind us, mostly, as Mike mentioned. Maybe in interest of time, we move on to some other topics. What's next? Peter, maybe chat a little bit about ETF share class, crypto.
Yeah. So I get all the doom and gloom topics. That's okay. The ETF share classes, on May 16th, Vanguard had a patent that expired that guarded their ability to run out ETF share classes in a mutual fund. They've been doing it since the early aughts. Is that right, Pip? When did they start? About 2002 or something like that?
Yeah, good 10, 11 years.
10, 11 years ago. So they've had a long run with this. The types of funds, if I recall correctly, they were using mainly large cap equity securities funds. They've done some fixed income stuff, but it's all pretty transparent, all pretty index-based, simple products. The only thing I can tell you is that from having talked to the SEC staff about this, and I think everyone else on this panel can agree with me, is that the SEC is, to say the least, not enamored with this product, this wrapper attached to a mutual fund. Their concern right now is having to deal with the issue of whether or not the mutual fund classes are somehow subsidizing the ETF's class costs. And the original order that went out from the SEC allowed Vanguard to do it, really focused on the benefits the mutual fund shareholders would get by having an ETF share class to lower costs through in-kind transactions, as well as the tax management effects that would benefit the mutual fund shareholders. I mean, there have been some hiccups with these things, very rarely. And I think I'm only aware of one. It had to do with a Vanguard fund that had a lot of increasing value in the portfolio, followed by very large redemptions out of the mutual fund side, which meant that the ETF share class got enormous capital gains distributions with the tax effects attendant to it. And that was, it rarely happens, but it's something you have to convince the SEC apparently that it won't happen with your share class, your ETF share class. Well, that's kind of where we are on that. I wouldn't expect to see it, was it perpetual, right?
Right. So there is an exemptive application on file, and much like the first ETF exemptive application, I think a lot of people in the industry want to piggyback on the expenses of the first one, doing battle with the SEC. But like Peter said, others have had informal conversations with the staff, and they haven't been real rosy to date.
It's really interesting because, as you mentioned, one of the major effects of the ETF rule that was applauded by just about everyone in the industry was that it really did put everyone on a level playing field. And that has definitely not always been the case in the history of the ETF industry because of the development of exemptive applications over the years and how some of the earlier entrants effectively had preferential terms just by virtue of going first, and the SEC later thinking of concerns that it had and that imposed restrictions on subsequent entrants. So it would be ironic if essentially the SEC didn't allow didn't allow subsequent entrants to use the structure similar to Vanguard based on concerns that the SEC developed after the Vanguard model was well up and running.
Okay, so the next issue is dealing with the cryptocurrency.
Crypto, yep, thanks.
Yeah, and right now there's litigation between Grayscale and the SEC and the DC Circuit, challenging the SEC's denial of a listing rule to their Bitcoin spot exposure, exchange-traded product. I mean, as practitioners, I think we make a difference between things that are exchange-traded that are regulated by the 40 Act, which we all call ETFs, exchange-traded funds, and then things that aren't under the 40 Act, which we call kind of like generically exchange-traded products. But the industry doesn't adhere to what the lawyers say all the time, so we just make the distinction. Anyway, there are a number of Bitcoin futures-based ETFs. These are 40 Act regulated products. They use controlled foreign corporations that hold Bitcoin futures contracts. that works for a variety of reasons, for tax efficiency and whatnot, but you're still looking at a product that's giving a total return between, let's say, a treasury bond portfolio and then this controlled foreign corporation's performance on its futures transactions. There's one of the first pure commodity pool plays was a product called DeFi. That's all it has in it is commodities, Bitcoin futures contracts. So right now, all we're looking at is products that are on the market that just have Bitcoin futures contracts. The CME trades two kinds, minis and regulars, I guess. Then we're looking at a complete resistance by the SEC to issue listing rules for anything that would give spot exposure directly to any cryptocurrency.
Great.
And we actually, just about a week ago, we saw a number of companies try to file for regular 40 Act ETFs that would hold Ether futures rather than Bitcoin futures. Now, Ether futures also have a good-sized market that is, that's fully regulated by the CFTC. So, after almost 2 years ago, the SEC allowed Bitcoin futures ETFs to launch. There's been a lot of speculation maybe Ether futures would be next. But to this point, the SEC has not been willing to do that. And within about 48 hours of the most recent batch of Ether futures products being filed, they had all or almost all been withdrawn, clearly at the quote-unquote request of the SEC. Great.
Bib?
And you definitely get the sense the SEC does not like Bitcoin, and it's far-reaching. I mean, when I was there eons ago, it was hard to get the commissioners and chairman's attention on anything from the Division of Investment Management. Now, there are directives that I'm assuming coming down from the chairman's office, and it's reaching into everything, even ETFs that invest in other ETFs with crypto or some of the products. They're getting lengthy comments. So ESG, cryptos, anything to do with the names rule is just highly scrutinized these days.
Thanks for that. Great discussion. Maybe that's a good segue into ESG funds and the rule proposal. Allison?
Sure. So we can spend a whole day on ESG, but right now we're going to spend about 5 minutes, so it's going to be very high level. Many of you have been to many panels about ESG, and you're probably wondering, where's it going? What's the SEC going to do? What's it going to look like? And the answer is nobody really knows. So you mentioned the ESG rule proposal that came out. It was a try for the SEC staff to try and figure out how to regulate ESG. Some of which maybe made sense, others of which probably doesn't make sense. This is all along the lines of what you're seeing in Europe, which I'm not sure there's been a lot of discussions between the two, but obviously for many of you that are global asset managers, it becomes very important, especially if you have portfolio management teams that are running similar strategies in each of the jurisdictions and trying to reconcile each of the sets of rules. When it comes down to it, it's difficult, especially in the US where there really isn't a set of rules. So what are we dealing with now? I would be remiss if I didn't mention there's also a names rule proposal that would come into play and affect ESG as well, both of which are pending, both of which we don't know exactly what the timing are. So in the meantime, we're dealing with the staff's comments. Now, of course, that sounds easier than actually what it is, because if you looked at the comments that have been publicly filed and that we've received, they're all over the map. And you can look at, for example, 2 ESG funds or 2 sustainability funds, and the comments are going to be very different. The disclosures are going to be very different. And that just goes to show you that, first of all, I think we all have to admit this is a very difficult set of funds to regulate, and I think nobody really knows how to do so. So what we're talking with clients about is actually quite simple without any real rule here. And that is, do what you say and say what you do. Now that sounds super simple, but what we're finding is it's actually quite difficult, because when you dig in on it, maybe in certain instances or with respect to certain securities in the portfolio, you're doing a little bit more than other securities. So what should the disclosure look like? How are we going to market this thing? Right? What are the marketing materials going to look like? And you have to be very careful about it, because some of you are well aware of some of the enforcement actions that have come about that are simply, they didn't say what they did. So there really is, and here's a plug for the legal and compliance departments out there, it's really important that you talk to legal and compliance on this sort of thing, because it's going to be their job when they are speaking with the SEC, either in the form of a new product or with respect to SOX comments they may receive or on marketing materials, to figure out what are you really doing what you say you're doing, and by the way, in addition, what are you doing on an ongoing basis to ensure that what's in that prospectus is not evolved, because much like everything else in the world, especially around E, S, or G, things are evolving. So at what point do you maybe have to update your disclosures? At what point do you have to clarify disclosures? My rule of thumb has always been less is more, and stick with the high level, and therefore you can't get it wrong. The problem is the SEC comments are really digging into the minutia, whether in the form of a supplemental response letter or in the disclosure itself. And then when you start trying to reconcile those disclosures with the disclosures that you have in your European documents, it becomes very difficult, because those disclosures in Europe are going to look different than the US. But what if the strategies that are the same? How different can they possibly look? So these are a lot of the discussions we're having. Frankly, this patchwork of comments makes things very, very difficult. And I think we're going to continue to see a patchwork of comments, all of which are inconsistent. But what you can do, and what your counsels, I'm sure, and everybody on this bench is doing, is really looking at what are the comments we've seen to date on the SEC, either on our behalf or have become publicly available. Think about them when you're formulating what you're doing with respect to your prospectus disclosure. And of course, you can't forget about the boards. The boards are going to want to dig in. They've seen the enforcement actions. They want to make sure that they're doing their oversight, some more than others, with respect to what's going on with the fund, especially when they're approving a fund. So their understanding is crucial too. So what does this mean? This basically means before you go into a new product especially, you really want to understand what's going to be done with respect to the portfolio management process to make sure that you are saying what you're doing and doing what you're saying.
Great. Thanks very much, Allison. There's going to be more discussion on ESG funds this afternoon. Thanks for laying the groundwork for that. How about single stock funds, Bib? We've been talking about them for a number of years.
Sure, and maybe I should start by explaining what a single stock fund is. And essentially, it's an ETF that owns, or is trying to track the performance of a single stock. So unlike all the other ETFs out there that have a basket, a portfolio of securities, it's a single stock. So that leads to the question, well, why would anybody want to buy a single stock ETF and not buy the Google or Apple directly? And while there are a variety of types of these products, most of them are leveraged or inverse leverage. And so you can get 1.5, in some cases, 2 times exposure to a single stock. And as an investor, that would be somewhat cumbersome if you try to do that yourself, you know, with options and other derivatives. So that's the thought behind it. What's interesting is the single stocks came out right when the 18F4 derivatives rule became effective. And as a result, the single stock funds, like all other funds using derivatives, had to comply with the value at risk VAR test. And what that meant for the single stock funds is the SEC required you to look back over a period of years, obviously compute your VAR, and in a sense, if it was a volatile stock for whatever reason, it would limit your ability to leverage or inverse leverage. So if you look at them, and they're typically come in families where one fund complex is offering 20, 25 of them. They vary, like Exxon maybe 1.5, Apple 1.75, and you're scratching your head, why aren't they all 1.75? It's because the value at risk test. And believe me, this is scrutinized. You don't just have your reviewer, you have the VAR team from the SEC, and they're looking at all the numbers. And one thing I want to mention too is that they're all domestic stocks, and that's an SEC position. And while this was a case where single stock international ETFs were filed, like Aramco, and the SEC requested, if I can use that word, maybe demanded, that those be withdrawn. More of the stated reason was that the underlying stock, in the SEC's view, since it was foreign, it wasn't subject to 10K requirements, the scrutiny of a U.S. listed stock. And the SEC said ultimately, the investor is getting a return based on the underlying stock. And there was a lot of rumors that it was that these things would have destroyed the ADR market, things like that. But at the end of the day, the SEC said no, and they grounded that in a legal reason.
Great, thanks, Bib. Maybe we shift gears for the last 5 minutes. We've done really well as a legal and compliance panel, talking about a lot of different products. That's great. Peter, with not certainly last but not least, maybe we talk 5 minutes or so on the oversight rule for providers.
Yeah, there's a rule proposed by the SEC that investment advisors, this applies to all of them, it doesn't matter whether they're fund advisors or not, but they have to do more heightened vetting of service providers that are critical to them delivering investment advice to their clients. What this means is it comes back to definitely for advisors using index providers to track their funds or benchmark their funds against, have to enter into new types of arrangements with those index providers to, among other things, make sure that those index providers somehow are compliant with federal securities laws. So you see that with the other types of service providers we're looking at in this area. Is a host of them, but clearly it's going to impact index providers through an indirect regulation of these service providers through the investment advisors that's registered with the SEC. So we have index providers, pricing services, model providers, you name it. It's any third party that the advisors rely on is critical. There's history on this. Allison, you want to go talk about the request for comment on what they issued about index providers, service providers, and model portfolio providers and pricing services?
Sure. I think I'm going to back up for 1 second, just say when you're talking about index providers in particular, because it's relevant for this audience, probably a bunch of you know that the SEC has always wanted to try and get their grubby little claws into their businesses, and they haven't been able to do so because they're generally not SEC regulated.
That's why we always advise advisor clients, if you want to form an index provider, do it as a separate legal entity so the SEC can't crawl around inside of it.
And so what this, in effect, is doing in another means is trying to get more intel on what's going on at these service providers. And so they have requested comment historically on how should they be regulated. And as many of you know, it's a slippery slope. And frankly, Jeremy and I were practicing together when this first came out. And our question to the SEC is, what are you thinking? And their question back to us was, well, what are you thinking? Can we get some idea? So that really gave us some intel on how far they were along on how to try to figure this out. And what's always a little bit tricky is this came out around the time that you were starting to see smart beta all over the place, and you could define it any way you want. You can use whatever terminology you want. But at the end of the day, they were looking for something that they don't know how to draw the line on. So if they were going to say that this type of index provider, this type of index falls on this side of the line and should be regulated, and then this type of index falls on this side of the line and should be regulated, I think everybody in the room could, and everyone on this panel could admit it's not that easy. And by the way, one of the great questions that we asked them was, well, what are you going to do for all those index providers that are being used in all of these ridiculous number of ETFs? You're going to go back and you're going to tell them they have to be regulated. It's a costly business. They don't get paid, I think everyone could admit, a ton under these contracts. So at the end of the day, are they going to do so? Or ETF's going to lose their indices? And by the way, for the lawyers in the room, those of you know that sub-advisory type of arrangements need to be regulated under 15C. So you're going to go back and tell each of these funds that they have to go to a shareholder vote to try and get this put in place if they don't otherwise have relief to do so.
And that would also, you have to get shareholder vote if they change the index or nuance the index in an evolution of the index. It's really fraught.
Yeah, no, that's exactly right. And for a while, the SEC was floating the idea that, just to specify, that maybe index providers should be regulated as investment advisors. And that would come with all of those formal requirements that Allison and Peter were just describing. And in addition to that, they've always been, the SEC has been wondering about the role of bespoke indexes. And the extent to which those implicate, the direct involvement by the ETF's investment advisor, and whether that essentially turns the index provider into a sub-advisor. So in a statement that was made by the then head of investment management, Dahlia Blass, about 6 years ago, and in the request for comment that the SEC came out with a year ago, the SEC floated the idea of possibly regulating index providers as investment advisors. In the proposed rule, however, they backed away from that in favor of, as Alison described, a way of trying to indirectly get at the index providers. So even though while the rule proposal affects other providers, other types of service providers, clearly this proposed rule is almost certainly a way for the SEC to try to get access to index providers.
Good.
On the other side, I mean, kind of these things were hatching a while back ago because somebody would have a brilliant idea for an ETF. Maybe it's a professor. They, first of all, would not want to have to register with the SEC, so they would just be a sponsor. And then also that instead of making it actively managed, they would put it in an index with rules. And so you really had kind of the smart beta concept. So you had this outlier who was trying to avoid any kind of SEC regulation, and you had the means to do that through this concept of a sponsor. And I think that's, the SEC, it's always bothered them that they can't reach those people. But their approach is a sledgehammer, and at the end of the day, it's, they're going to run into a Supreme Court decision that won't allow them to directly do what they're trying to do. So by doing it indirectly and trying to extract all this information from the regulated entities, it just doesn't seem right and fair at the end of the day.
I think just to sum it up, it's
kind of
a solution in search of a problem.
Yeah. So no timeline.
No, there's a lot of industry pushback. There's a lot of foment on Capitol Hill about this too.
Yeah, though at a major industry conference a couple of months ago, the head of the Division of Investment Management essentially endorsed the rule very strongly. And I think to the extent that provides tea leaves, it probably means that some version of the rule will be adopted sooner rather than later.
And the only other thing that I'll just add to that is even if we don't see the rule anytime soon, as everyone knows, these proposed rules creep their way into examinations and otherwise, so I wouldn't be surprised if and I have started seeing some of those comments along those lines and them kicking the tires on what that oversight is.
I think thank you, great discussion. I think we're at time, maybe one question or any questions from the audience I wanted to at least solicit. Well, no questions. Great, thanks very much, panelists, great job.